Welcome back from the break. We want to look at other issues now that have to be looked at during consolidation, and we will start with differences to single line consolidation, so other issues when applying equity accounting. So we have a lot of intercompany transactions also with associates. So what would we do when we have a transaction between an associate and, well, a group company? So the problem is that we will only show assets and liabilities in the consolidated financial statements of subsidiaries. So even if you have a receivable from an associate, you cannot eliminate that one because you don't have the equivalent liability of the associate in the financial statements. So therefore, we cannot crosscast, we cannot eliminate group accounts in or intercompany accounts in the group accounts. So that is why we would have to look at these transactions differently. So same thing in the balance sheet and also in the income statement. We do not have, for instance, if we rent a building, the parent rents a building from the associate. Well, the parent has rental expenses and the associate has rental income, but we do not show the rental income of the associate in the group accounts. So we cannot cross out the rental expense from the parent with the rental income of the associate, because we only show the rental expenses. And therefore, these problems arise in the practice that we cannot crosscast intercompany transactions between group companies and associated companies. And the same is true for the intercompany balances between group companies and associates. So if an associate is acquired during the year, then profits and losses have to be time apportioned. That is also something that we have to look at when we acquire, or when a parent acquires another company that is an associate. Then the profits that will be shared by the parent, by the group, will be have to be related to the post-acquisition part only. So we have to time apportion the profits or losses that the group will get from an associate. And well, then it gets more complicated if the associate recognizes any amounts in other comprehensive income in the post-acquisition periods. The appropriate share of the parents will also be recognized in the group's other comprehensive income. But that is just, don't forget, if these things arise in practice, we will not look at these more complicated stuff in the exam. And of course, the dividend income, which is based on payments, is not reported in the group statement of profit or loss, as the appropriate share of profit is already shown in the year when it is earned, not in the year when it is paid. So we would rather use the dividend if it is paid to deduct that from the investment, because when an associate pays a lot of dividends, then of course the value of that investment is going down because they use the cash that is of course a value. Okay, so these are other issues that you have to consider when you are applying the equity accounting. So the equity accounting is not perfect. It is just a compromise between a normal investment and a fully consolidated subsidiary. So it is an animal that is in between those two worlds, you could say. All right. Well, we now have looked at subsidiaries, full consolidation. We have looked at associates, equity consolidation. And now we will have to look at the accounting for joint arrangements. So you remember we have joint arrangements. We have shared control in a company when we have two parents or two entities that are jointly controlling another entity, and that entity is called a joint arrangement. So the joint arrangement could be a joint venture. Oh, I forgot to mark this one here. So maybe I can do this. So that should be joint. It was joint control. Oh, I cannot see my. Oh, I can see it. So please mark that out and say this is a joint venture. They share control. Sorry, I will have to venture. Okay. It's written with an E. So it's this one here. So I corrected it here, but I forgot to put that over there. I'm sorry. So examples of joint venture is when you have two parents, 2 times 50, or you have 3 parents, 3 times 33. So obviously you should not call them parents because they do not control. They have joint control, but they cannot control them alone. So we in that case, well, I have to put that back again. So how can I do that? Laser pointer, no. Laser pointer, oh, that's also nice. Okay, so maybe escape. Yes, that works. All right, so we have this joint control. Oh no, it's correct. I'm sorry, I was a little bit confused. So joint control is the correct term, but joint arrangements, well, they will either be joint ventures or joint operations. And the joint venture is when 2 or more jointly controllers, 2 or more companies or entities jointly control another entity as a whole. So that is 1. So we have a joint venture when they jointly control that joint arrangement. So that means that you will have control of the net assets here. And when they look through the joint arrangement, so the entity A is controlling the gas pipeline. They are managing, operating the gas pipeline. And B is controlling and operating the power plant. But they do that via a joint arrangement, then we would call this joint arrangement a joint operation. So please forget this one here. That is control. That is joint control. Okay, I'm sorry. Now, when we look at the accounting for these things, then Please have a look. I really like that animation. And there is another one. Okay, I can put that away. All right, so the accounting depends. So it depends on what? Well, the accounting depends on the type of joint arrangement. So if it is a joint venture, then you will use the equity method. If it is a joint operation, then you will use the quota consolidation. So that's basically it. So what is the reasoning for that? Well, when you are jointly controlling an entity and you have access to the net assets, but you do not have the right or obligations to single entities, to single assets or single liabilities as you have in a joint operation, well, then probably the best thing to look at that joint arrangement is to look at it as one investment. And that is why we would look at the joint venture the same as if we have a significant influence, we have 50%. So we have a significant influence and we will account for that similar as if it was an associate. So basically for joint ventures, we use the method which we already know, right? So we have in the parents' single financial statements, we have one line, and that is in the single financial statements called the investment. And then we will take that line and put it into the consolidated financial statements and then make adjustments to that line according to fair value increases, dividends paid, and profits shared by this joint venture, and so on. Yeah, so we already know this method, so we don't have to look into an example for that because that is the same thing. So when we have a joint arrangement, which is a joint venture, we will use the equity method. If we have a joint arrangement that is a joint operation, so we will use the quota consolidation for those kind of contracts. So what is a quota consolidation? Well, let's first look at the equity method. I think so the characteristics of a joint venture is here joint control with others, no control over this entity, but at least significant influence. So that will be used, the same accounting method, as I said, will be used as if it was an associated company. So, well, you know that already, the equity method. So please look at India or Delhi and just think of Delhi to be a joint venture. So if that was a joint venture, then the accounting would and the consolidation would just work as if that was Delhi was a joint venture. But if it's a joint operation, well, we have to use the quota consolidation. So the characteristics of a joint operation is that you have control with others, no control over the entity, but control over certain assets and liabilities. So if you have control over certain assets and liabilities, so why don't you just put those assets and liabilities that you have control of into the balance sheet? So in that case, you would add another column into our consolidation table, and just put those assets in that you control from a group's perspective, right? So a quota consolidation is similar to a full consolidation, with the one exception that you only put in those assets that you will control. So for instance, in our example for the joint operators, the joint operator A puts in tanks, pipelines, and other infrastructure, and the other joint venturer B puts in the sales buildings and the car fleet and the power plant and so on. So I think you get the idea that when you have a joint operation, it is more like you control certain assets and liabilities, and therefore you would use the quota consolidation to put in those assets and liabilities. Whereas when you are a joint venturer and you don't have access to assets and liabilities, you would take the equity method, which is used for associates. So we really don't need to learn more consolidation methods. We already know the principles, and that's the whole story. All right. So do we have any questions regarding the accounting for joint operations? No? Okay. Well, then we are very quick today. We can look at we can look at normal investments. Oops, that was backwards, sorry. So, well, how are normal investments accounted for? And I think that is the easiest part. So for instance, if you have a group represented by this little graph here, a graphic, you have a parent, ABC, and it is called parent because it fully controls XYZ, the subsidiary. They have more than 50%, so they control. This is the group that has to set up the group accounting. And then we have two other entities which happen to be there. They will not be fully integrated, fully consolidated into the group. We know that already for the DEF Corporation. They are considered to be an associate because ABC has no control. They have less than 50% of the voting rights, but they have significant influence, and therefore they will just account for DEF as an associate using the equity method, so a one-line consolidation. And then, well, we have another investment, which we would just call a normal investment. So that is less than 20%. Normal because you don't have control and you don't have a significant influence. So it's nothing special. So what is the accounting? What is the accounting treatment for this normal investment? Well, when you look at the investors' separate financial statements, then this normal investment is accounted for as a non-current financial investment. So you will see such an investment in the non-current section, and you will see it under financial assets. Any dividends that the company, that this investment will pay, will be recognized in the year when the payment is performed. So when we look at the equity method, we would increase the value of the investment when there is a profit. And when the dividend is paid, we will decrease the value of the investment. So we will do it completely differently in the case of a normal investment, because in the year when they make a profit, we will not increase the investment because we have no significant influence when this dividend will be paid. Okay, so we just ignore that this normal investment is making profit. We will just state that investment at cost. Or if that investment is has its share on a stock exchange, we could of course value this normal investment at fair value using the stock information, the stock price information. But normally we will not account for the dividend or for the profit and not for the dividends. Well, we will, of course, when the dividends are paid, that will be recognized as income from investments, but that's all. Now, what are we doing for the consolidated financial statements? So in the group accounts, ABC in this case will show a normal investment that they have accounted for as in the single financial statement at cost or at fair value if they are listed. So they will also show that investment in those financial investments in financial assets. So there is no difference between the accounting in the single financial statements or in the group accounts. It will just be taken from the line investments and will be put in investments in the CFS. No big change. There will be no goodwill because we don't pay a premium. There is no NCI because we are the NCIs, right? We are holding a minority in a normal investment. And well, you know that IAS 16, the revaluation method can also be applied if you are valuing that financial asset under IAS 16. So you can revalue the item, but that is a choice. You are not required to use it. But when there is an impairment, of course, you have to impair the normal investment and you have to show the loss in the consolidated financial statements. So you will have to show expenses. The impairment loss will be recorded as expenses in the consolidated income statement. And if the situation gets better, then of course you have to reverse that impairment. So that is also then shown as an income from a reversal of impairment of a normal investment. And that is basically it. So that's the accounting treatment for a normal investment. So this is, I think, yeah, just using the normal principles of IFRS and bookkeeping, I think you can manage to do the normal accounting for a normal investment. Okay, well, any questions to this easy stuff? Obviously, we first took the more complicated things and now end up in quite easy accounting for the special things. All right, so if there are no more questions, then I would like to go to special issues. And special issues will start with foreign currency issues. Uh-oh, okay. Foreign currency. Now, I think there is one big problem with foreign currencies. People tend to mix up foreign currency translation and foreign currency translation and foreign currency transactions. Okay, so what is the difference? Well, when you look at the individual entity level, then we are looking at foreign currency transactions. So the company at individual entity level, they are selling from Vietnam to the US. And well, in the US, I think they don't like the dong, so they will pay in US dollars, and also the market price will be set in US dollars. So the companies in the US will not like to pay in dong unless, well, the Vietnamese company is a price setter. As you may have heard, they can set the prices in dong, but okay. So that is why we have foreign currency transactions in a Vietnamese company when they sell their products in US dollars. So that is a foreign currency transaction. Or they purchase, the US companies purchase in yen when they buy from Japan. When they do their bookkeeping in US dollars, well, then yen is a foreign currency transaction. Or you have some people from abroad. So maybe in a Vietnamese company, you have some guys from Germany advising the Vietnamese companies, and well, they don't like to get yen. I'm sorry. They probably want to have euro. So when the Vietnamese company is paying those experts in euro, then when the company has a bookkeeping in Vietnamese dong, then the payment in euros is a foreign currency transaction. So whenever we are looking at the individual entity level, when we have foreign currencies involved, then we are talking about a transaction that is performed in foreign currency. Okay, so that is different from local currency. And well, we also have presentation currency. So that is the one used for reporting. And we have a functional currency that is the practical bookkeeping currency. Okay. So I know that sounds a little bit complicated, and yes, it is. So be very cautious when you look at foreign currency and try to find out where am I? Am I in a foreign currency transaction, so at the individual level, or maybe am I at the group level? And when we are combining different financial statements, so financial statements that were prepared in euro, other subsidiaries prepared their financial statements in dong, other subsidiaries prepared them in yen. So we have a problem of translating those foreign currency financial statements into the reporting currency, and that is the problem. So please do not mix up transactions and translation. So whenever you look at at a company level at the transaction, then we are talking about a foreign currency transaction. And whenever we want to translate foreign currency financial statements into another currency, then we are talking about a translation. Okay, so that is what we have to distinguish and what we have to be very cautious about when we talk about foreign currency issues. We have to understand the difference between a transaction in foreign currency and a translation into a foreign currency, or from a foreign currency into a reporting currency, for instance. So some theory has to be also here. So first we have to look at IAS 21, which is on the effects of the changes in foreign currency exchange rates. So whenever we want to set up IFRS financial statements, we have to follow IAS 21, which is on foreign currency. Now, well, the standard prescribes how the entity should account for foreign currency transactions, so on the entity level. But it also describes how to translate financial statements of a foreign operation into the entity's functional currency. Oops, functional currency. What is that? Local currency, functional currency, and reporting currency. So local currency, I think, is clear. Yeah, that's dong in Vietnam, euro in Europe, US dollar in the US, and basically that is the local currency where the company is based. So if a German subsidiary is sitting in Vietnam, well, the local currency is not euro. The local currency in Vietnam is still the dong, right? So we first have to figure out what is the local currency. Well, and then we have to look what is the presentation currency. So that is the currency in which the parents, the group accounts, are presented. So when we look at Daimler, well, they are situated in Germany. So the local currency obviously is euro. But they are also using that currency, the euro, as their reporting currency. So for the German subsidiaries, no problem. They will set up their local financial statements in euro, and then they don't have to translate those amounts into the reporting currency, because that's the same currency, right? And well, functional currency is now something that the standard setter has used as a term, and we will now look into what is a functional currency. So if there are different financial statements set up in different currencies, we have to translate them into the presentation currency. But, well, what is the functional currency then? Well, the standard setters said that the functional currency is the currency in which the entity is primarily working. So what is the primary economic environment of an entity in which cash is generated and expensed? So whenever a transaction is in a different currency, then it is a foreign currency transaction. So these are the definitions by the standard. Well, we will look into a practical example which will show how this can be done. So please use this form I will send you into breakout rooms now. And please determine what is the local currency. So put that in here. So for instance, if a German subsidiary is located in Vietnam and buys and sells in US dollar, and the parent of the, whether the financial statements of the parent are in euro, then obviously the local currency of that German subsidiary is dong because it sits in Vietnam. The functional currency, well, what is the primary economic situation? So you have based on that one, you have to find out what is the functional currency for this one. Well, the presentation currency is easy. It's already given. And then we have some transactions. And for instance, the staff payroll in Vietnam is in Vien Dong, Vietnamese dong. So is that a foreign currency transaction, yes or no? So you please click or say yes or no for each of these 12 examples. So I will send you now into breakout rooms, and welcome back. We just looked at the functional currency determination. We had 4 companies, and we looked at several transactions. And I think you clearly got the message. Well, the local currency is something that is a given. You just look out of the window and see in what currency people are paying when they buy something. So that is easy. The next thing is the presentation currency. That is also easy. These are determined by the group accounts. So in which currency the group accounts will be presented, that is the presentation currency. Well, and then we have the functional currency, and here is the problem. It is something in between the local and the presentation currency. We have to determine that because IFRS uses that kind of a vehicle to transform all the currencies or the foreign currency transactions into the functional currency. So that is what IFRS requires. And so we have to determine the functional currency. And the definition is that this is the main or the prime economic environment in which a company is working. So even if a German company is sitting in Vietnam, but the most transactions that they do is in US dollars, so it does not matter what the local currency is in Germany. It does not matter whether the local currency in Vietnam is VND. The functional currency is US dollar, because that German subsidiary in Vietnam buys and sells in US dollar. So their prime economic environment is the US currency. So therefore, the company has to define what is the functional currency, and they have to agree that with the auditors. I think the auditors would object if such a company would select maybe the Chinese currency to be their functional currency. They are not living in that economic environment, so the Chinese currency would not be the correct functional currency. And what is also true, you will see that in practice, that most of the time the bookkeeping will be done in the functional currency, because then the transactions that have to be recorded in foreign currencies are minimized. So all the sales, all the purchases in this first example, when they will be done in US dollar, you don't have to change. You don't have to translate this transaction into another currency, because it's already in the functional currency in US dollars. Okay, so I think that is okay. And then we have several transactions here, and I think you all got it right. So any transaction currency different from the functional currency is a foreign currency. That's the definition. So anything which is different from the US dollar is a foreign currency transaction in this block here. So VND euro is clearly different from the US dollar. So these are foreign currency transactions. And the payment to the US consultants in US dollars, well, these are not they are not foreign currency transaction, because the transaction currency is the same as the functional currency. Okay, so you just look at it and say, what is the functional currency? That's the one that the company has determined and has to agree with the auditors. And then when there is a transaction in a different currency, well, that is a foreign currency. It's as easy as that. Although it might sometimes be confusing, because why would we use a functional currency of US dollar of a German company sitting in Vietnam? So that's a little bit confusing, but I think you get the principle. First, you have to find out what is the functional currency, and then any other transaction in another currency will be a foreign currency transaction. Yes, and I think I don't want to go through all of these. You got that right, what I saw. Well, the problem was here, okay? So that was clearly not a clear picture. A Vietnamese subsidiary in the US, they buy in Vietnam from their home country, and then they sell in the US to make good profits. The financing obviously is done via Japan, because they offer low cost money. And well, the parent financial statements, the group financial statements is in Vietnamese dong. So they use three currencies to work in, to live in. So what is the functional currency? And here there is no black and white answer. And therefore the company should ask their auditors what to do. Well, probably they come up with their own decision and consideration and discuss that with the auditor. So in that case, I would look at, well, they are sitting in the US, they are selling in US dollar. So selling is obviously a very big cash in. So maybe they have some payroll cost in the US dollar. So maybe it's, but it's not clear, it's not black and white. So I would suggest to the auditors, this company should use the US dollar as a functional currency. So therefore, if the auditors agree, well, then you can answer the questions here. And in the exam, please give an answer. So make your decision clear here, why you would choose one of these currencies to be the functional currency. And I'm an auditor, you know, and I have to look at your exam. So if I agree with you, then you're, no, I'm kidding. If your arguments are okay, I will accept, of course, your decision. And based on that decision, please give the answers here. So if you decide here that the VND is the functional currency, I would accept that, but then I would, you would say that, you would have to say that VND for giveaways is not a foreign currency, right? And euro is a foreign currency, and US dollar also. So it would change the answer, right? And based on your decision here, I will then correct or agree with your answer that you give here. All right. So I think you should take away well, one basic thing from this table. When you are dealing with foreign currency transactions, then you have to determine the functional currency first. It may be the local currency, it may be the presentation currency, but what it is defined by the standard setter, IASB, and they said the functional currency is the main economic environment in which the company is doing its business, and therefore you have to determine the functional currency based on hard facts and look at the company. All right, and then any other transaction or a transaction in any other currency is called a foreign currency transaction. Okay, so we have the key messages for takeaway is we have to define the functional currency of an important, because that is very important. Most of the time it will be the bookkeeping currency also, but this is not a rule. So just from my observation in practice, most of the time or very often the companies will maintain their bookkeeping in the functional currency. That might not be the local currency, and it might not be the presentation currency, the reporting currency. So if the company enters into transactions in other currencies, these transactions are called foreign currency transactions. Sometimes it will be difficult, even a matter of judgment, to determine the functional currency. And it will be a judgmental decision which currency is the functional one. Well, what are the criteria or indicators for that decision? Well, the currency in which sales are performed, I think that is a very good indicator, because sales should be the biggest cash in that the company has. So there is a good reason that sales could determine the main economic environment. So the sales prices, the currency of the sales prices. Or when you look at the material that you buy, the payroll cost or other cost, patent licenses and other things where you have big cash out streams, well, that could also influence the main economic environment in which a company is working. Or if financing is not done by own equity, obviously they will then get loans from banks or other investors. And the question is, in which currency will those activities be performed? So that could be also a main environment in which they live. So which is the currency in which they get the loans or the financing from others. Yeah, and when the currency in which receipts for operating activities are usually retained. So where do they invest their money? And well, that's another criteria or indicator. So what you have to do in practice is look at the facts and circumstances, and then find out what is the environment in which the company is operating, and that will influence the functional currency. So in practice, you will find that management will argue that the currency of the parent is heavily influencing the economic situation of the subsidiary, to make it easier in the communication process with the parent. But sometimes the auditor will disagree with that practice. So I think in practice, you will have to view that the auditors might not accept the decision. All right, so these were the key messages. And well, we have already, because you had not so many questions, I think we have now come up to the end of the day. So I will stop the recording. Stop.